Let's kick off reaction first, though, to the jobs number. Light wages, Leslie, average hourly earnings, lightest since June of 2021. Better labor force participation, especially among the older crowd, 55 and up.
Yeah, the market clearly likes what it sees. A very clear reaction to the print when it came out. That 3.8, when was the last time we talked about the unemployment rate? We haven't necessarily, because it has been historically low for such a long time. And going into the print, economists were expecting it to be 3.5, 3.8. Huge upside surprise here. And of course, Mike, the key narrative this week and in recent weeks has been bad news is good news.
Yes.
And the question, I think, remains, and you can see this from the reaction today, is how long that sentiment really carries through into equity.
Yeah, we're in that comfortable zone where moderating activity takes the edge off of bond yields, off of Fed expectations, doesn't yet really hit the core expectation that the economy had a decent amount of momentum coming into this period. I do think we have to explore where the border is when bad news does not necessarily help the markets. But for now, I do think mostly because, especially coming into the last week or so, everybody was focused on things look too hot in terms of GDP in the current quarter. 10-year Treasury yields, maybe they're going to break out of their range. They didn't, and they're in retreat. The 2-year now below 4.8 as well. So this is definitely bolstering the idea. Look, we're landing, okay? It's a question of how soft or hard. The numbers in terms of the last 7 months of downward revisions to jobs reinforces the JOLTS message. Somewhat moderating wage growth has been a very important piece of that, because otherwise you're talking about wages too sticky even as job growth goes down. So we're okay for the moment. I think the market has probably correctly said earnings estimates in the last 6 weeks, when we were last at 4,500 and change in the S&P in this level, earnings estimates are up 3%. 10-year Treasury yield up a bit, not a lot. Oil kind of made a run higher. Now it's still in the mid-80s. We're okay with that. So it sort of boils together as we haven't had to really reprice assets in a dramatic way based on the backdrop. So we're okay for now. I still think we haven't called off the wait for further lagged effects, further weakness potentially. And so I'm just alert to that narrative shift that could be coming.
Yeah, it is curious. The Journal today actually echoes what Boston Fed wrote about earlier in the week, and that is takes 5 quarters for some of these things to really start hitting corporate balance sheets and maturity walls. You add NFIB, jobs hard to fill, Conference Board, labor differentials. Mike mentions JOLTS.
Yeah.
When do we start talking about harder landing? Today, B of A, look at Michael Hartnett, says you do want to sell the last rate hike, and he points to some signs in retail and housing as signs that this might be start looking more pernicious soon.
Well, it's also September now. Today's September 1st, just to remind everybody, which means that, we're looking at 1 month until the government runs out of funding. The resumption of student loan interest payments starts today, or interest starts accruing today. The payments themselves don't start until October 1st, but nonetheless, it's going to change the way that consumers start thinking about what's going on in their own bank accounts. And then, of course, you've got the excess savings, which some economists and investors are predicting will start to really be completely drawn down to zero and maybe go negative as soon as this month. So all of those factors are the lag effects that people have been waiting for. Now, whether or not today's numbers indicate that the economy is strong enough to, withstand some of these headwinds, I think is a big question.
Over 150,000 jobs per month is fine if that's where it stays, or even if we moderate down from there. You don't have this massive pool of workers we're drawing from. It is really a question of trying to anticipate, the next potential turn, or if we have to absorb some kind of a shock. I don't think government shutdown's enough to be a shock like that. But right now, and again, it's also a matter of, what's my relevant time horizon investment-wise? If I sort of feel as if, look, this is enough of a good backdrop through the fourth quarter, and that's all I care about for my year, because we've already been up 17% year to date in the S&P. September doesn't tend to be as bad when the market is up in this zone. The rest of the year has tended to actually have some follow through to the upside when you're here. Maybe we don't have to worry about that. We just push it off. I agree with Hartnett in the sense of the last rate hike itself is not really bullish, but really it's the first cut. The first cut is, and that's why I've always been arguing that the stock market is not rallying based on the hope of a rate cut. It's rallying based on the Fed's nearly done. If the next move kind of doesn't matter that much. If it went too far, it already did. So let's not worry about what happens next. It's really about if they're forced to cut, it means that the economy is giving us something to worry about.
And today, full pricing of the first cut moves to May from June. So we're going to start to watch that.